Does using the HELOC method to pay off your home really work faster than paying additional towards your mortgage? Everyone who sells this program says it does, so it must, right? If it does, we should be able to duplicate the results using a mortgage calculator rather than a whiteboard. And in this video, I'm gonna compare using the HELOC method to paying additional towards your mortgage and see which option works better. Now, I did a video about this previously, comparing putting the full amount of your mortgage on the HELOC to paying additional toward the mortgage. Now, according to one comment from that video, the way to pay it off faster is by chunking $15,000 to $25,000 from the HELOC towards the first mortgage. So in this video, we're gonna chunk it. Now, for those who haven't heard of the HELOC method, here's how it works. First, you open up a home equity line of credit. Second, you can either pay off the full amount of your mortgage with the HELOC or make a payment of $15,000 to $25,000 from the HELOC towards your first mortgage. Third, you treat the HELOC as though it's your bank account and deposit your full paycheck, which satisfies the minimum payment that is due. Fourth, you pay bills from the HELOC. And fifth, you repeat until the HELOC is paid off, then put another $15,000 to $25,000 payment towards the first mortgage. If you do that, you'll pay off the home in 5 to 7 years instead of 30. Now, I know there are some companies selling courses on this, so if you've researched it, please let me know in the comments what they're charging. Now, let's set up our scenario. We're gonna use a loan amount of $363,920. The average first mortgage rate of 6.55 on a 30-year fix. Now that's according to Freddie Mac. The average rate on a home equity line of credit of 7.8%. Now that's according to Bankrate. Remember, this rate is fully adjustable, so anytime the feds lower or raise rates, this is directly affected. Now, in the previous video, I used the median household income of $70,784, which meant about $60,000 in take-home pay or $5,000 per month. Now, some people commented that for this to work, you have to have higher income than that. So for this video, we'll use a take-home pay of $7,500. Now, for the loan amount of $363,920 and a rate of 6.55, that will make our mortgage payment $23.1220, which will pay off the mortgage in 30 years if we make the minimum payment. Okay, let's look at the HELOC method, putting a chunk towards the first mortgage of $25,000. Now, I wanted to use an online calculator so you could duplicate this yourself, but each one I found only allowed for a lump sum to be paid once a year, and I wanted to make a lump sum payment once the HELOC was close to being paid off, since this is the way that it's recommended. So I had to build a calculator. Now, some that are teaching this method use a whiteboard, but I figured it's best to use an actual calculator for this. Now, for the calculator, the left side is a traditional amortization schedule that's been customized to allow some one-time payments as well as extra payments. You can see the schedule matches the calculator on Bankrate here. The right side is for the HELOC. So HELOCs calculate interest using the average daily balance for the period. So to take advantage of this, I set up this calculator to account for the paycheck being deposited at the beginning of the month and any other bills to come out at the middle of the month. This will reduce the average daily balance so that the interest charge is based on a lower amount. Now, when I compare this calculator to the one on Bankrate's website, you can see that the interest is lower since we're accounting for the lower average daily balance. Now, month one, we open up our home equity line of credit and we pay $25,000 towards the first mortgage. This would technically satisfy the payment on the first mortgage, but to keep things consistent, I have the first mortgage payment coming out each month as seen here. Now, we're gonna deposit our full monthly take-home pay of $7,500 after the first statement comes. Now, according to the plan, we pay our bills out of this HELOC. So to make it easy, let's say all the bills, excluding the mortgage, are $2687.80 per month. If we use this method, we still have to make the minimum payment on the first mortgage of $2312.80. So let's add that to the $2687.80 for other bills. That means $5,000 will be coming out of the HELOC on the 15th to satisfy both of those payments. Now, if we do that, we can see the HELOC would be close to being paid off by month 11. And we would then take another $25,000 and apply it towards the first mortgage, which reduces that balance. If we continue this, that would pay off the primary mortgage by month 94, which would be just under 8 years. And we would continue making the payment on the balance of the HELOC until month 101, which is 8 years and 5 months. Now, when we look at the last 6 months for the HELOC, our additional monthly charges would drop to $2687.80 per month instead of that $5,000. And this is simply because the first mortgage would then be paid off. Now, if we look at the payments on this, out of the $7,500 take-home pay, $2687.80 was going toward other bills, and the remaining $4812.20 was going towards the mortgage payment and paying off the HELOC. So our minimum payment on the first mortgage is technically $2312.20 per month, which means an additional $2,500 was actually going down to pay the HELOC off. We know that the amount was $2,500 because if we take $7,500 and subtract the mortgage payment of $23,1280 and our other bills of $26,8780, the amount left over is $2,500. Now, what happens if we add that $2,500 per month to the first mortgage? Using that same bank rate amortization schedule, let's see what happens. Now, using this calculator, we can see that paying that additional $2,500 towards the first mortgage actually pays it off in 98 months or 8 years and 2 months, which is 3 months faster than the HELOC chunking method. If we didn't chunk and instead put everything on the HELOC, it would actually take 103 months or 8 years and 7 months. Now let's look at the difference between the monthly options using the same amount of monthly cash flow. Also, if you find value in this video, please like and subscribe for the YouTube algorithm. I'd appreciate it. Okay, so here's what we have. The first position HELOC, now that's when you take the entire amount and put it on the home equity line of credit. That took 8 years and 7 months. The second position HELOC, which is using the chunking method, took 8 years and 5 months. And then paying the additional towards the mortgage took 8 years and 2 months. Now, I will say the HELOC method works better than making the minimum payments on the mortgage, but it's not really a fair comparison. If you compare paying an additional $2,500 towards your balance versus not paying anything at all additional, it's a pretty big difference. What you really want to do is compare a couple of different options using the same amount of money to see which one will pay it off faster. The first mortgage wins in this scenario simply because the interest rate is lower on the first mortgage. But if the rate on the HELOC were lower, then the HELOC method would actually pay it off a bit faster. Now, I know there are some videos out there saying, wait, HELOCs are simple interest and first mortgages are amortized interest. But let's take a look at this. Amortizing is a way of calculating a minimum payment in order to pay off a loan in a certain time. It is not a type of interest. In fact, the website Investopedia says it best. There are 2 types of interest that can be applied to loans. They are simple and compounded. Simple interest is interest that is calculated based on the balance of a loan, whereas compounded interest is interest that is calculated based on the balance plus any accumulated interest on the loan. So interest on interest, right? Think of it this way. Let's say you borrow $100 from a friend and your friend charges you 10% interest per month. Okay, so maybe your friend is a bit of a loan shark, but anyways, just stick with me here. The interest on this loan is $10 per month. So if you pay the $10, the balance is $100. So the $10 is simple interest. Now, next month's interest would also be $10 and so on, okay? So let's say your friend doesn't make you pay the minimum payment of $10. So next month, the balance is $110, right? We take the 100, we add the 10, $110. Now your 10% interest charge is $11, not 10. Then next month, the balance would now be $121, and the interest for that month would be $12.10. That would be compound interest. See, we have interest on interest, right? Back to the mortgage. What some people are really trying to say is that the interest charged is the fixed amount on the first mortgage because it is amortized, but that's not how it works. If we look at the amortization schedule for this scenario, once we make a $25,000 payment, the interest for the following month is immediately reduced because the balance is reduced. That shows that the interest isn't fixed and is based on the balance. This is why paying an additional $100 towards your mortgage actually pays off the loan faster. If the interest was fixed, paying additional towards your mortgage wouldn't really change the interest charge, and there wouldn't be much of an advantage to paying extra towards your mortgage. Here's a comment from a Velocity Banking YouTuber. They say that the home loan interest is compounded, and that's why making extra payments may knock back baby interest, but the compound will happen until the very last payment is made. What is baby interest? Please comment below if you know what this is. It's pretty clear that regular fixed rate mortgages are simple interest loans. With an amortized loan, you'll never pay interest on interest. So another thing I see is people saying, wait, if you put extra money towards your first mortgage, you don't have access to it anymore. Okay, yes, that is true. But what you could do is open up a home equity line of credit and just keep it at a zero balance if that's something that you're worried about. That way you can pay down the mortgage faster but still have access to the money in the event of emergency. Now, if you've been researching this method, you may see some comments as proof that it does work, such as, trust me, it does work. And you may also see some comments about people saying, I paid off my mortgage in 7 years by putting chunks onto the principal. Now, we did see that if you did the HELOC method versus not doing anything at all, you will pay off your home faster. But we also saw that if you applied additional money towards the first mortgage, it would actually be paid off faster. Now, I think HELOCs can be a really great tool depending on what you're using them for, but there are some drawbacks. If you suddenly have $100,000 available, consider what you would do with it. If you aren't disciplined with that money, you could get into a lot of trouble really quickly. And the balance on that HELOC can also affect your credit score. Now, this video right here will tell you all about how that HELOC can affect your credit score as you draw from it. Now, guys, if you like this video, please smash that like button. And if you disagree or felt I missed something, please let me know in the comments. I'm open to looking at other methods people use to pay off their home faster. Thanks so much for watching. We'll see you on the next one.